The energy drinks market is growing, so where's the best place to invest? Let's do this! Right, in this episode I'm going to be talking about the energy drinks market. The global energy drink market has been growing at an annual rate of about 5% since 2013. In 2018 it was valued at around $53 billion and it's been growing at an annual rate of about 7% and predicted to reach $86 billion in 2026. And the biggest beverage companies are taking note and are already making moves into the market. Coca-Cola, for example, already owns 19.4% of Monster Energy. Pepsi spent $3.85 million last March to buy Rockstar, then announced they had bought distribution rights to Bang, made by Vital Pharmaceuticals. Dr. Pepper are entering the market with Adrenaline Shock, which is a reduced sugar and natural ingredient option. Here's some stats from Caffeine Informer that has studied the top selling energy drinks in the US last year. Red Bull leads the way by an impressive margin, almost doubling its rival Monster Energy, who again doubles their next rival Bang Energy. Red Bull and Monster's sugar-free drinks are neck and neck, but are just a fraction of their sugar-filled versions. What stands out is that whereas Monster and Red Bull seem to have peaked, Bang Energy and Celsius have seen respective jumps in sales of 80% and 86%. With Celsius being a fairly new entry into the market, independent from big drink companies, it has been receiving a high level of interest. Celsius Holdings have been around for about 16 years, with its stock barely noticed until back in 2018, with sales of $52.6 million. But 2019 saw sales jump 43% to $75.1 million, and since May last year, when it traded at around $6, the stock has gathered some incredible momentum, driven further by media attention, driving up by an impressive 350% over the last year. But are these stock movements justified by the company operations? The company is just starting out and is pushing a niche of having energy drinks that are healthy and actually taste nice compared to their rivals. The company markets the drinks as thermogenic, meaning it helps you burn calories by increasing your heart rate and body temperature. Its drinks are free of sugar, fat and preservatives, whilst boosting various vitamins such as B and C, which boost its nutritional value. 1 treble flora ounce or 354ml can of Celsius is classed as 1 serving, so there's no distortion here. And each portion provides 200 milligrams of caffeine, which according to European Food Safety Authority's scientific opinion is the maximum amount that can be considered safe in a single dose. Mintel Market Research reported in May that one of the barriers to consumer purchasing when it comes to energy drinks is a notion that they contain too much sugar, caffeine, unhealthy ingredients, or just don't taste good. So a product that doesn't have any of these issues could be a winner, and Celsius seems to have taken the initiative. But these aren't factors that Celsius can monopolize in the long run, with a number of leading brands now moving into the same area. Of course, Celsius has a website with information on their products, but I compared this to Bang Energy, who showed almost the same growth last year. Now, Bang Energy offer an abundance of interest in flavoured drinks, along with merchandise, apparel, accessories, protein shakes, supplements and gift cards, all of which are available to order direct from their website, which also offers information on events and recruitment. In my opinion, Bang Energy seem to have a more wider range of product offerings, which also extend their marketing edge. I imagine the product range is a benefit of Vital Pharmaceuticals having a leading edge, plus the marketing is likely due to Pepsi's long-time experience in this area. Now, marketing is a key factor in this industry. Retailers are only willing to set aside a certain amount of shelf space for these types of products, and they certainly are unlikely to set aside limited shelf space for more established and better selling products. But whatever products these companies do offer, their success seems to be dependent on the strength of their marketing positions. This creates a lot of hostility between competing brands, with accusations against each other over how they are competing or promoting their rival products. In 2018, Monster was accusing Bang of using aggressive marketing campaigns based on faux science, along with attempting to steal their trade secrets and store shelf space. Whereas Bang accused Monster of having an inferior product containing suspect ingredients and likely to cause heart and general health problems from their high sugar content. Then in November last year, VPX tried to end their 9-month partnership with Pepsi over distribution of Bang, accusing them of aggressive tactics against retailers. But Pepsi was able to fight back through arbitration and secure an emergency order to retain sole distribution rights until 2023. When Dr. Pepper announced they were forming a new partner brand, Adrenaline Shock, Celsius accused them of mimicking their thermogenic product with similar claims of boosting metabolism and even packaging being too familiar. I don't see the argument over packaging, but this does highlight the issue where Celsius doesn't have a monopoly over healthy ingredients in energy drinks. With beverage giants entering the field where Red Bull and Monster Energy have clear dominance, it seems that Celsius is in a David and Goliath situation. But their growth indicates that they could be setting up investors for massive returns in the future. But is that really the case? To clear this up, we need to look at the financials. But first, remember to smash that like button if you like what you see and you want to see more.
Like me, open up your eyes and insert a little rising. You don't have to love me, you don't have to like me. Got enough love in myself, in my psyche. You should have the same in your brain.
Now normally I would take all the data and put it in a single chart. The problem is the difference in scale between the bigger companies like Coca-Cola, Pepsi, Dr. Pepper and the energy drink only companies is so big that we end up with a chart like this. As you can see, these energy drinks companies barely register. The energy drink market is quite dense, so in order to review this properly, I'm going to focus only on the companies who specialize in energy products to find the trends that warrant some interest. I'll also be removing Monster due to their size, but we'll come back to that later. Red Bull isn't included as they don't trade stock publicly. So with that done, we have an obvious contender with Celsius, who are showing year-on-year revenue growth, almost doubling within the last 2 years. They have seriously overtaken Reed over a 4-year period in which they seem to have stagnated. Guru is also showing some impressive growth, just not to the scale of Celsius, so I'm going to put Celsius in first place. Costs and profits seem to reflect the rising revenue with similar trends, which is to be expected, so we can call this another Celsius win. But net income and EBITDA is more complex and suggests that Celsius has turned around massively since 2019, coming up from negative to positive earnings. Reed seems to be showing an alarming increase in debt, whereas Guru seems to be having some concerns. Celsius are also losing earnings, but have been able to stay in the positive as of late, so we might as well give them another win. And that makes Celsius the clear winner when it comes to earnings and growth. Now let's look at assets and liabilities. Now Celsius and Guru seem to have some good figures and assets, but Guru seems to have a massive expansion by percentage over the last year, retaining these over the last quarters. Remember, we are cutting out brands with much larger figures so we can review the patterns, so the same rule applies here. Guru comes in first, Celsius second. When it comes to cash, Celsius seems to have picked up some good cash levels over the last few years, but the last few quarters have seen this dissipate. Guru has developed some good cash numbers over the last couple of years, but has seen some of this lost over the last few quarters, but not to the same extent. Reed continues to disintegrate. Guru takes first, Celsius second. Now liabilities, Celsius has maintained some consistency, whereas Reed has some reduction in liabilities. Guru has a gradual increase, and there's nothing drastic here, but if we look at debt, we can see that they have all brought their debt down to more reasonable levels, and I'm going to reward them in order of improvement. Generally, the companies have done well since the last year to pay down debt and raise cash, but over the current year they are losing cash. Celsius at a faster rate than Guru. If we look at equity, it shows Celsius with some high figures here, but Guru seems to be showing the greatest percentage increase, second to Reed. However, debt equity ratio shows Reed to be in a particularly bad way last year, although they have improved at times. Celsius seems to show the most consistently low ratios, so comes in at first, Guru second. Lastly, shares issued shows that Celsius and Reed have been selling shares, diluting their stock value. Reed seems to have sold the most by margin. Celsius has been increasing shares consistently year on year, including recently. Guru sold a bunch last year, but has been buying them back this year, so I'm giving them first place, Celsius second, Reed third. So if we tally these up, we can see that Celsius appears to be a winner, and Guru comes in at second. Reed might as well be left alone. However, remember we removed Monster due to how their size distorted the charts, and if I add them back, they show positive patterns in every single chart, with consistent growth in sales, profits, assets and equity. They have no long-term debt, and rather than diluting their shares, they've been buying them back since 2019 after announcing a $500 million buyback scheme. So on the fundamentals, Monster is the clear choice. So why isn't Monster stock rallying like Celsius? Is it because the hype is true and Celsius is going to be the next Monster, so it's the best investment? I don't think so. The issue with Celsius is that compared to the established brands, they are having to spend a good portion of their resources on marketing and distribution costs, where they don't yet have the distribution network or the scale to compete on the same level, relying on marketing events, product giveaways, social media, and low-end celebrity endorsements. So I don't think they have the budget for more large-scale and impactful marketing strategies. The benefit of the bigger brands is that they are able to spend fortunes on large-scale advertising campaigns and participate in major sporting events and commercials, using massive budgets to create massive brand recognition and result in sales. Dr. Pepper introducing adrenaline shock demonstrates how easily Celsius could be undone by a stronger competitor making a rival product, and Celsius are making moves to counter them. But being such a small company, the last thing they need is to be wasting cash losing legal battles. CEO John Feedley spoke about boosting their e-commerce channel, where they have seen a 100% growth over the last year. This isn't a bad move given how sports clubs and retail stores have been affected by the pandemic. Going by the last quarter earnings, they have 15% of their sales coming through Amazon, which has taken a portion away from Monster and Red Bull. But this isn't the most cost-effective revenue stream when you consider their fees. Celsius's main focus is to expand their distribution network through drugs and retail stores, along with international sales. They have secured a 50-year manufacture and supply deal with China, where they hope to benefit from cheap production and a massive market. The issue I have is that I don't trust Chinese stocks or any company that is too reliant on good relations between China and USA. This has served me well by avoiding the various scams and pitfalls that Chinese investments have incurred lately. Now if we look at the current stock price, at $65, Celsius is trading at 570 times earnings, despite the recent stock dilution. And I think this has been driven up by too much media attention, too much hype, too much momentum on the stock. Not on the profits or the fundamentals of the business, with the most bullish investors being those who already own the stock from lower levels, who will of course benefit if people keep buying, but pumping and pumping and pumping a stock doesn't make up for the company's weaknesses, and it's only a matter of time before it crashes. The reason stock dilution may not be the last, and I'm inclined to sell, not buy at these levels. I think the more likely outcome is that Celsius will come down from their highs and end up being acquired by a larger beverage company who are able to provide them with the distribution network and the marketing budget that they need to have any significant role in the market. So here's the bottom line. The issue with the energy drink market is that it's effectively priced in, with too many companies fighting for a piece, with too much marketing and not enough shelf space to go around. But there is growth to be had. If I was going to buy into the market, I'll be looking for strong and long-term fundamentals, not hyped up momentum stocks. Having collected data on various beverage companies and filtered down to the metrics I'm looking for in investments, out of the entire lot, I think Monster is the best choice, who at $95 are trading at a forward PE of 31.02 and a price of sales of 10.56. Their large operating scale, strong fundamentals, consistent growth and stock buybacks all point to a good investment. Also, Pepsi stands out as a more diversified investment. At $156 a share, they trade at a lower PE of 23.64 and price to sales of 2.9. They have the benefit of exposure to the energy drink market via Rockstar and Bang, plus the advantage of a more diversified product range, and Pepsi's larger marketing strengths and distribution network. The stock provides a decent and steady dividend of around 2.77%, and if the Bang deal does eventually end in 2023, Pepsi could be putting an offering towards Celsius, if it hasn't been bought out by then. Out of the two, I'm more than likely going to buy Pepsi, because I like diversification and I do love a dividend. So that's my take on energy drinks, and I hope you appreciated the video. If you have any thoughts, questions, ideas, please comment below, let me know, and please consider subscribing so you don't miss out on future videos. Until next time.